Ladies and gentlemen, please welcome on stage your moderator and distinguished panelists.
Welcome to today's panel, Exploring Monetary Policy in a Shock-Prone World. I'm Julia Chatterley, anchor of CNN. The IMF announced the very welcome news this week that global inflation battle is, quote, almost over. And so far it's been achieved without a global recession, without severe market volatility, despite what's been a historical period of global policy tightening. And now, for the most part, at least in the advanced world, interest rates are coming back down. That's the relatively good news. The bad news is, as we're all well aware, the economic risks continue to build. We've got rising protectionism, a US presidential election where both sides are talking tough, some more than others, some wars, of course, too, in Ukraine and the Middle East. Geopolitical and economic fragmentation is deepening at a time when collective action on issues like climate change, labor supply, new technologies, high debts and debt forgiveness is urgently required. And all of these issues combine to make the system significantly more susceptible to shocks and therefore more challenging to navigate, as you'll hear. Managing the ship in calm and in rougher waters are central banks. And now they're engaging in a whole wave of policy framework reviews that present what we hope will be an opportunity to incorporate lessons learned over the past 4 years. Enough of me. Please, may I introduce our panelists. Geeta Gopinath, the first Deputy Managing Director of the IMF, Rosana Costa, Governor of the Central Bank of Chile, Francois Villeroy, the Governor of the Bank of France, and Ricardo Reis, Arthur Williams, Professor of Economics at the LSE. Geeta, I want to start with you. Please. Advanced economies, with a few exceptions, Japan, Australia, have decided that they can ease interest rates. You're encouraging that too, I think, wherever possible. But there clearly are plenty of risks. What worries you most about that process in line with what we're seeing elsewhere in the world today?
Hi, Julia. So let me start with the good news, which is that inflation is coming down in many advanced economies towards central bank targets, and we should celebrate that because that was not a foregone conclusion. And it is to the credit of central bankers that they've helped to keep inflation expectations at the long run anchored, and that's helped bring inflation down without a big hit to economic activity. Now, the unwinding of supply disruptions helped, but at the same time, if you compare this episode to the previous 1970s episode where inflation was very high, and it took a lot of loss of economic activity to bring inflation down. This time, we didn't have that. So looking ahead on the path of easing, we do expect to see the US, the euro area, to continue to ease policy, but we see the Fed taking longer to get to so-called neutral rates as compared to the euro area. And that's because growth is stronger in the US as compared to the euro area, and so therefore it makes sense for there to be a longer period before you get back to neutrality in the US as compared to the euro area. In terms of the risks, I'd say there are two sets of risks that point to why inflation could be higher than we may be projecting, and one where it could go in the other direction, or why rates may have to move in different ways. So one is what happens with fiscal policy. Our assumption is that there's going to be smaller fiscal deficits, both in the US and in the euro area. If that's not the case, and there is much more expansionary fiscal policy, then that will add to inflationary pressures, and you could see maybe not as much easing taking place as we're currently projecting. The second is what comes from geopolitics, including, say, oil prices going up, or what comes from a big round of tariff increases, which have inflationary pressures, and that again moves in the direction of interest rates not easing as fast as one might expect. There's one that goes in the other direction, and this is something you raised earlier, which is we see this disconnect between the volatility in financial markets and the level of uncertainty there is. So the volatility is low compared to how elevated the uncertainty is around geopolitics, around trade, around fragmentation, and so on. If there is a sharp correction in financial markets, then that tends to have a dampening effect on demand, and you could end up, in that case, central banks reacting with much faster cuts in interest rates. So these are some of the risks that we see.
I mean, there's a lot to cover there. Ricardo, come in here. But it's not just about, as Geeta was saying, the journey. It is about the destination and where interest rates ultimately end up. How are you thinking, given all the challenges, all the uncertainties, stock markets, financial markets where they are, what the neutral rate of interest is?
Well, first of all, thank you for having me. Like Geeta noted, as we're entering a stage where inflation is stabilizing and we're going back to a normal situation, we can start talking again about steady state levels, neutral levels, where we'll end up, and that terminal rate, as you noted, or as you called it, will arrive soon. Now, to try and figure out where it is, one useful starting point would be to say maybe we're going to go back to 2019. If that is the case, estimates then of neutral rates were around 2–2.5% for the US, maybe 0.5, 1%, or around 1% for the ECB. However, I think that it would be incorrect to do so. The world has changed since 2019 in a way that, in my view, lead to a higher interest rate moving forward. To see why, let's look at how we got to the numbers in 2019. Those are low numbers historically. You used to think of normal neutral rates closer to, say, a 4%. And yet, over 20+ years, interest rates had fallen, R* had declined, maybe 20 years, maybe as much as 30 or 40. Now, if you look at the factors, and we had a very, very large, extensive literature trying to look at what had driven that fall in R*, what's remarkable over the last 3 years is that most, not all, but most, have reverted. Let me start with the four, starting from the one that has changed the least to the ones who have changed the most. Demographics, that's barely changed in the last 3 years. The age of the population had pushed the R*s down. But number two was public investment and change in the relative price of capital. Well, public investment has picked up in the last few years after the austerity wave post-financial crisis, and so that's going to have a positive effect on R*s, even though quantitatively not a very large one. Third factor, though, and now an important one, the safety and liquidity of government bonds, which were extraordinarily safe for 20 years as a safe haven protected from not just default, but especially inflation. Boy, after the last 30 years, if you're a bondholder and you still look at a government bond and think a nominal government bond is a very safe thing, after you've lost less than 20% of your investment, you really have to wake up and smell the coffee. They're not that safe and liquid anymore. The demand should be lower. You should expect, therefore, the R*, the price, to be higher. And then the fourth factor was famously called by many scholars, including Ben Bernanke at the time at the Fed, the so-called savings glut. China and other countries in Southeast Asia running very large current account surplus, which means saving abroad. And because of the capital controls that they had, that savings abroad was channeled by the government and led to an accumulation of treasuries and other safe government bonds outside. Well, what have we seen in the last few years? Not only the Chinese current account is smaller, the surplus is smaller, the outflows are smaller, but especially, and not just China, but Southeast Asia, you see a movement away from treasuries, from government bonds alone. That factor as well will push for R* to be higher. So all of these factors are reverted, and some in a quantitatively serious way. But now let's add another fact, Julia, which is that the terminal rate depends not just on R*, but also, let me call it pi star, for the Greek letter for inflation, long-run inflation.
Can you put it into English for the people that aren't economists in the room?
Where do we think inflation is going to go?
Oh, thank you.
As Geeta well noted, inflation seems to be re-anchoring at around 2%.
Okay.
And so we have not seen a drift out of what expected inflation is. But we do see that the risks associated with inflation have increased. If you measure inflation risk premium Again, going back to investors, how much compensation they want, how much higher interest rates they need to compensate for the risk of inflation, they have gone up. You see that directly when you try to measure those. You see that even more recently due to the increase in term premia, how much you want an interest rate to be on a longer term bond, which is more subject to that inflation risk or not. Add it all together, Julia, and the increase in that inflation compensation, as well as in the structural forces that are pushing R-star up. And I would go as far as venture that the new neutral rate for the US is probably around 3.5% to 4%. And for the ECB, maybe around 225, 275, knowing that there's a lot of uncertainty around us. Importantly, because of that uncertainty, it means that as central banks are cutting, I think they must be very well aware that they may not cut as much as they thought that they were if you're going from a pre-2020 world. And two, that you really need to feel your ground in the dark as you're cutting, figuring out where that unknown R-star plus pi star, if you want, where that neutral rate is, and be very careful not to go on a very predetermined, very bold path.
Okay, so just to summarize that, if I can very quickly, then what you're saying is the end game effectively is perhaps 1 to 2.5 percentage points higher than originally we thought it was. The uncertainty is great, so you have to do so carefully when you're cutting rates.
1 to 1.5, not 1 to 2.5, 1 to 1.5 higher than maybe what it was. And therefore, that as you're cutting towards it, you have to be careful that you land softly at that right level of interest rates rather than crashing through it and having another burst of inflation.
Yeah, I was just trying to incorporate the United States and Europe into it. Francois, what do you make of that? That's sort of uncomfortable to hear.
Yes.
If you believe him.
I will say, I believe Ricardo half, but I will explain. No, but before coming to the destination, Julia.
Yeah, the journey.
Can I come back to the start of the
Please.
journey, as described by Gita? Because central banks have been successful in fighting inflation. And remember 2 years ago, it was not done. Probably many of us in this room would have feared recession or a high sacrifice ratio. Why was it better than expected, and why was it, as you said, Gita, much better than 50 years ago with the Volcker episode? I think the key difference is credibility, and it gives some light for the future. By the way, we had some Banque de France research trying to measure these credibility gains. I won't enter into details, it's public, but we used a DSG model with bounded expectations a la Woodford, and we came to these results, which are very interesting. That credibility, you measure it by the fact that inflation expectations have been much better anchored this time. Would inflation expectations have disanchored? Probably we would have, in the euro area, we would have had to increase interest rates till 8%. Instead of 4%. We would have lost 2% output, and inflation would be around 6%. This shows with significant figures the credibility gains. And this gives me some light for the future, if I may come to the destination. R-star is a very interesting object. It's almost a theological object. I am an R-star believer, I must say. But why is it theological? Because you cannot precisely measure it. And I'm very grateful to Ricardo for his nice try. So I think it's useful, but we should be cautious in using it with precise figures. My feeling for the euro area, and this is why I believe Ricardo only half, is that clearly R-star stopped its secular decline, or we had 2 decades of decline. We are sure that it stabilized. I'm not sure in the euro area case that it increased. So I think your figures are a bit too high. But this is my personal assessment. What could be the destination of the journey? Again, built on this past credibility, which is our strongest asset. I am fully aligned with President Christine Lagarde when she says the following thing, which is very wise. The direction of the journey is clear. We have room to cut rates, obviously, and we will. But the pace will be highly pragmatic and data dependent. And by the way, this is probably a way to measure whether we are getting closer to our star or not. What is sure, if I look at the present situation in the euro area, we are at 3.25. We are still quite far away from our star, so we still have room of maneuver.
Governor Costa, Rosanna, your views on this? You can opine on where we're headed, but also the impact of what we've been through over the last 3 to 4 years, because your experience is a little different in Chile.
First of all, I would like to say that it is a good news to perceive, to see the advancing control of inflation. This is a very good news for globally, for our country, for emerging countries in general. It's a very good news that in the United States you can see the controlling inflation, and that permit the beginning of the change in the monetary policy in the United States with its globally effects over the world. However, recently we have been seeing the effect of what is happening with the stress that geopolitical is introducing in financial markets. Recently we have seen, for example, that while the movement in the monetary policy rate in advanced economies that had produced reduce in the restricted condition in fiscal condition, in financial conditions globally, then the stress in geopolitical events is moving up long-term interest rate. And that was a reversal of all the advance we have seen in terms of the reduction in the restrictive conditions, financial conditions globally. So it is important, I want to mention 3 aspects that I think that is important to take into account. First, we have seen that in terms of the long-term rates are becoming more sensitive to news, to new pieces of news, and this is a new event. Normally, traditionally, when you have a new piece of information, the volatile reaction of the market was in the short-term variable. But now, this volatility is present in long-term interest rate. And this is something very important, I think. I perceive that it is reflecting doubts that is present now in the level of the neutral rate mentioned by Ricardo. Second topic is the changes in the correlation of key asset classes in response to negative news. Traditionally, what we can expect when we have a risk-off event, we can expect that dollar will appreciate, prices of stock goes down, and long-term interest rate goes down too. What have we seen recently after the episode in the Middle East? We have seen that the expectation is that in a world in which many advanced countries has very high level of public debt, the event is producing expectation of an increase in defense expenditure, and that produces that after in a risk-off, the movement is going to an appreciation of the dollar, going to a reduction in stock prices, but long-term interest rate goes up. So we have to look carefully what is behind that. The event behind that could be what indeed the fiscal monitor is pointing very precisely, level of public debt in many advanced countries is behind this new reaction when the event is related to the level of public debt too. And the third point is inflation expectation. Inflation expectation was very important, has been very important in all the process we have seen, but what could happen if after all this process, after controlling inflation, all this geopolitical and all the stress we could perceive in the circumstances we were living, push up again or stress again up cost. what will be the evolution of inflation expectation after an episode of high inflation. We need to control, to manage very careful inflation expectation in these conditions.
Okay, we're going to come back to that because I think that's vitally important. I think the general consensus is that we know how the inflationary episode was created, what the causes were. I think the broader expectation is that, to your point, I think that expectations were for the most part handled for a number of different reasons. Ricardo, just to be the contrarian, you sort of beg to differ, at least for a short period of time in the year to sort of the end of 2022, that actually for a small period, inflation expectations de-anchored. What's the most critical element, and this is really to anybody, but Ricardo, you can answer it, to ensure that is controlled? Is it swift action, even if perhaps in the past we would have looked through supply shocks? Swift action, communication, talking to the people and helping them understand why you're doing it and for what purpose?
I would say I disagree or that I differ. I think I completely agree when Francois says that inflation expectations were anchored. They're anchored now, and that was absolutely crucial to bring inflation down. I add a wrinkle, though, if you want, a slightly higher frequency wrinkle, which is that they weren't anchored throughout the whole episode. That if you look at the end of 2021 or the second half of 2021, many indicators showed a drift up of the expectations. And then when you look at around half of 2022, they all very decisively, very sharply re-anchor. So I completely agree with what Francois said, and Geeta before him, as well as Anna, that if one looks at an annual frequency, you would say they stayed anchored throughout. If you look at month by month, you certainly see a movement of the anchor up that re-anchors again. Why do I bring this little high frequency if you want? Who cares? Let's just think about years. I think it's important for two lessons moving forward. The first one is that re-anchoring, it may have been a coincidence, but if one looks at the US versus the Eurozone and even a few more countries, often coincided with exactly the hiking of interest rates. It may be a coincidence, but it is not enough to talk, it is not enough to communicate. Once you hiked interest rates, it was remarkable how expectations anchored quickly. And to be clear, I didn't expect them to anchor quite as quickly as they did. I was wrong, if you want, relative to 2021. And I think that was a big part of the success of this inflation process, how remarkable expectations re-anchored once central banks showed through their actions, through the very tight hiking cycle, how serious they were about bringing inflation. That teaches us, Julia, though, how important it is to, in the face of runaway inflation, to be decisive and to hike and to raise rates and be ready to do so. And so that's why I think it's important to add this wrinkle, not to think that, oh, expectations stayed anchored throughout. No, they stayed anchored precisely, and here I will agree very strongly with Francois, they stayed anchored because they acted, because they raised interest rates. And therefore, if there's a risk for them to de-anchoring again, it is actions that re-anchor them.
Yeah,
and so I think that's a very important
That's why we're here, because we want to learn the lessons of the past 4 years and make sure we handle it equally well, if not better.
The second lesson
quick,
I was going to say...
Quick, because he wants to come in.
The second lesson I was going to say was moving ahead, which is how well anchored are they? If the anchor was solid in the sand, drifted up just a little bit so the boat didn't move too much and re-anchored, it's not as deep in the sand now as it was, say, in 2019 or 18. They are anchored, but I do fear that if we have another large inflation shock, and here I think Geeta really pointed to the two key ones, problems associated with debt or with tariff wars, how confident am I that the anchor is going to stay solid? Or to put it even better, how needed is it going to be to have firm action to keep it anchored? I think is higher than it was in 2019-18. And I think that's the second important lesson moving forward.
Francois?
No, agreement on Ricardo on the description of what happened in 2022. And central banks had to walk the talk. Our credibility cannot be only on communication, and the liftoff was very useful. The two nuances I would introduce is that first, if you look at medium-term inflation expectations, they remain better anchored. Short-term were a bit disanchored. And second, obviously, we had to raise rates, but we had, these were my figure, we had to raise rates much less than in the past. And this brings me to the question, why so? Why this better anchoring? To be honest, the comparison is a bit difficult because if you look at the previous episode of the 70s and 80s, we don't have, under Ricardo's and Gita's control, we don't have precise measures of what inflation expectations were at that time. So it's a bit difficult to compare. But for sure, there are three elements which help to explain central bank's credibility and which are, for me, the three pillars. These are new elements compared with the 80s. First, central bank independence. Second, inflation targeting, because the 2% objective is very simple and understandable by all economic agents. And third, a subtle mix of action and communication in the past. To put it in other words, past credibility fosters present credibility. That said, credibility is an asset to be preserved. It's not an inheritance to be exploited lazily. So we have to be active, but a bit less than in the past.
To come in, because we're now going into a period where you've mentioned debt metric concerns. I hate to bring it back to the United States, but here we are. We have two candidates that are talking about spending trillions of dollars over the coming years. One in particular is threatening astonishing levels of tariffs. We have geopolitical risk, the risk of another potential oil price spike. How do we incorporate those kind of inflationary risks, not certainties clearly, but risks, with what we've learned about the past 4 years, and just to make it more exciting, incorporate, I think, the very important points that we've got about how financial markets are behaving today, because this is critical to understand, I think.
So this is a good time to be having this discussion because central banks in several countries are rethinking their monetary policy frameworks and saying, well, what lessons have we learned and what should we incorporate it? I think from our perspective, the simple description is that the change will be more evolution rather than revolution. And the reason is because of all what was heard, which is that this current framework did deliver in bringing inflation down without a deep recession, without a big loss in jobs. And so it worked, right? So the question is, but how can we do this better? And how can we make sure that we respond faster? So what's the evolution or revolution part? So the first thing on the evolution is how you react to supply shocks. You know, we've had supply shocks in the past. Oil prices have gone up. And the reaction is for central banks to typically look through those supply shocks, right? That's the reaction that you do. And then the pandemic comes and you have the energy crisis, and then these supply shocks compound. And I think the lesson to take away from these last few years is that when you have supply shocks across multiple sectors, you're hitting supply bottlenecks, not just in one sector, but in multiple sectors. At the same time, the demand is coming back. Then you are now facing a very different trade-off between output and inflation. So you need to move much faster in raising interest rates so that you can control that rise in inflation. So I think that's one lesson that we should take away. The second, in terms of the evolution, is to have a more risk management perspective. I mean, central banks do that. There are many times when they have more risk-based approach, but given the more shock-prone world we're going to be in, I think making that a bigger part of the framework is probably important. So it's not enough. So typical monetary policy frameworks will say, we're going to set our interest path based on our central forecast, our model forecast of what's going to happen to inflation, the central scenario over time. I think what these previous few years have shown us, and if we are going to be in this world with a lot more such shocks, is that we should take into account other scenarios. We're going to have to look at multiple scenarios, including scenarios where inflation is much higher than the baseline in terms of reacting. And then my last message is, whatever we do with our frameworks, let's not make a change where it comes like we're fighting the last battle. So the last time we had changes to the monetary policy framework, it was heavily tilted to fighting the last battle. And the last battle was too low demand and liquidity traps and hitting the zero lower bound, right? That was the big concern the last time around. So it was a very demand-centric view. This time, we've seen supply shocks play a bigger role. But that doesn't mean that the next reform of the framework should then become supply-centric. I think the fact that we're in a more shock-prone world basically means that we could see both more demand shocks and more supply shocks, and we should be we should be prepared also for the possibility that we may be back at the zero lower bound and with interest rates having to go down very low. I don't think we should simply not take that off the table.
Rosanna, your view on this? Because it's been a battle for you to bring inflation down despite raising interest rates.
Yeah. I think we were all speaking about credibility. At the end, we were all speaking about credibility and how to reinforce everyday credibility in what we are going to do. And credibility is the consequence of action and good decisions. During all these episodes, we have proved the efficiency of inflation forecast targeting models. We have known what it is, but in this episode, we have proven that it was efficient and it worked. And also, I think that there are three elements, very important, three lessons or three elements in all these episodes I would like to share with all of you. First, it is very important to have a very clear framework and to communicate this very clear framework. For the last 20 years, in the case of my country, our framework has two unchanged parameters. First, the level of the target. Our target is 3%, one precise level of the target for inflation. Second, the horizon. In our case, we have to achieve 3% within a horizon of 2 years. There is no doubt about which is the target of the central bank, and we could communicate it clearly. Second, it is very important to invest in capabilities. It is important to focus the work of the central bank in an agenda to improve modeling. It is very important to focus the agenda of a central bank in new sources of high quality and high frequency data, and to work with this and to understand better what is happening with the economy and the response to very different events. We traditionally work with economical shocks, but what we suffered was not only economical shocks. So the quality of modeling these events, of the disposition of high-frequency data, macro data, was very important during these episodes in the case of a Central Bank of Chile. And the third element that is very important too is communication. Strategic communication is very important for the central bank. And during the last 5 years, we built something similar to what Gita mentioned. We communicate monetary policy with a new tool. We have a corridor which is revealing to the market which could be the most likely path for the monetary policy rate in the case that the central scenario materializes in the economy. So this is a very clear message. And the second element that is present in this corridor is which are the sensitivity scenario that could be producing from now to the future near to the central scenario. So what we are revealing to the market in this corridor is a likely reaction function in which the Central Bank of Chile could act in the case that the evolution of the economy is moving or not to one side or the other of the corridor. So giving this information is a new tool we have been using during these 5 years. Is something that we have to measure the efficiency, we have to introduce carefully in the market, but is a new way to give information about the probability of the reaction of the central bank if the evolution of the economy goes materialize what we have in our central scenario.
Yeah. So more communication, not less, from the central bank, but communication based on higher quality and higher frequency data. So you hope what you're communicating is of higher quality. Ricardo?
If I can, on what Gita said earlier before the discussion goes somewhere. When he said, let's not fight the last battle or the last war, being often the problem. I want to link that to the beginning of my initial intervention.
Yeah.
Before 2019, we lived in a low R-star world. In a low R-star world, Julia, there are three concerns for monetary policy. You're going to run out of ammunition in terms of cutting rates. Therefore, all the innovation is let's create quantitative easing and a series of other policies that allow you to cut further. Two, deflation is the big risk. Being stuck in a deflationary period that lasts forever. Zero lower bound, as often that's called. And three, that there's too little aggregate demand. That is the big insight of Keynes with the so-called zero lower bound. The emphasis of central bank was on generating tools, worrying about deflation, creating aggregate demand. If indeed our star is now higher, as I noted, note that now we need to worry about inflation being a risk as well, credibility being used to tighten without tightening so much, and aggregate supply measures become important as much as just generating aggregate demand.
That's going to complicate your job.
Yes, but this is why the job is interesting. You know?
Keeps you busy.
No, I fully agree that we shouldn't fight the last battle. The challenge is, what is exactly the next battle? And the fair answer is we don't completely know. To put it with a question, is the next battle higher inflation for sure, or is it higher volatility?
Or both.
Or it could be both, but I would have a stronger feeling for the second answer, higher volatility, because we have more shocks in this very volatile world, and we have, as Gita and Rosanna said, more supply shocks, which is a challenge for us because we are more on the demand side. So we should analyze more these supply shocks and acknowledge that not all supply shocks are alike, including for inflation and including for monetary policy. The traditional answer is that we should look through. But we should really analyze the nature of supply shocks. To give you two obvious examples, is the supply shock temporary or persistent, or is it upstream in the economy with energy, for instance, which can then go to many sectors, or is it more downstream on some consumer segments? And this is not at all the same effect. So we should analyze, but we will live in a world of increased uncertainty. We had, Gita, this discussion in the last 2 days in the IMF. You mentioned it. We have a situation with very low volatility on financial markets, but huge geopolitical uncertainties. And I introduced in the discussion the famous discussion by Frank Knight 1 century ago between risk, which you can measure and hedge, and uncertainty, where you don't know the probability, know the outcome. And unfortunately, for all of us, not only for central banks, we live in a more Knightian world at present. So for the strategy review, I would agree with Gita, we shouldn't change too much. Evolution, or to say it with other words, for the various central bank staff, keep it simple. But we will have to incorporate this new Knightian world. I would say that we have to act. We central banks are also subject to this uncertainty. But we have to act as much as possible as uncertainty absorber for the economic agents, households and firms. And this leads me to a last reflection about the inflation target, and following what Rosanna said. There could be a temptation to say, you should change the inflation target, and if you think that it will be more inflationary, raise a bit. I think it would be a mistake. Inflation targeting is a key element of credibility and a key element to absorb uncertainty. The question we could have is that if we keep the 2% target, and we said very clearly for the ECB, next year we will keep it. Changing it is not on the table. But do we have some more flexibility around this inflation target? And there are at least two theoretical answers. The first one is flexibility in space, with margins of fluctuations, and some central banks have it. Rosanna is not a great fan, as you could see. I'm not either, but we could discuss. And you could have flexibility in time. Our 2% target does not mean that we are 2.0 at each moment. It's an objective in the medium term. But this is really food for thought for me for the next strategy review. So limited, sober, and adapted probably to this greater volatility.
Just to be very clear, though, you can, and we can and will do, argue whether what took place was good policy or it was also an element of good luck. And to your point about reacting or not reacting and how much you react to supply shocks, and that's what we could be shocked by in the very near future, depending on political events. How do you know and analyze which shock to react to, supply shock, and which perhaps not to, and how much? For example, have you gauged, had you not raised interest rates in the ECB the way that you did, where inflation perhaps would be today, to justify the decision that you made?
Can I give a very practical answer?
Please.
Looking at what we did and probably other major central banks after the end of 21. We had a commodity shock due to the COVID exit and then to the very unfortunate Russian war in Ukraine. We waited some months and we were criticized for that.
As was the United States.
Because it could be part of the traditional answer to look through. But the fact that really changed our analysis and did that we acted strongly was that this commodity shock passed through to core inflation,
right.
Services and manufactured goods. So it took a bit of time. But if you are credible enough, credibility also provides you time. You are not obliged to react immediately at the risk of wrongdoing if your past action is credible enough to say, I am committed to come back to 2%, but I will take the necessary time to analyze all this data. And as I said, the different nature of supply shocks, not all of them are alike.
Okay, it wasn't just about raising interest rates. There were other policy tools, liquidity, foreign exchange interventions, bond buying, another example. Ricardo, I think it was a decade ago, you warned that the danger of buying bonds was that at some point, central banks were going to be sitting on balance sheet losses. What have we learned through this period about the efficacy of bond buying and how that perhaps, and we can talk about it, should be utilized again in the future?
Well, as you note, we have learned quite a bit because luckily with experimentation and central banks did many different things in buying them, has now given us the data to speculate less, like I was doing with my dear colleague Robert Hall 12 years ago, and now actually be able to measure and see some of these effects. I think we've learned that QE can be a very valuable tool when it comes to monetary policy inflation control, and at the same time, that is especially valuable when interest rates are too low to provide an extra form of stimulus. And why? Because it takes quite a few million, or better even, billion of QE to get quite a bit of a kick that one can get more easily by hiking 25, 50, 75, or 100 basis points. So QE ends up having a certain asymmetry that comes from the fact that it's really much, even if QE itself is symmetric, which is doubtful, it will be more needed when there's less room to cut interest rates than not. So as a monetary policy tool, I think we've learned QE is very valuable, especially when we get the negative shocks. And I very much agree with Francois that we're now moving to a world that's two-sided uncertainty. I can see inflation being too low or too high going forward. If it ends up being that it's too low and we need to cut rates, then QE I think will become more valuable than if it's the other side around. As a financial stability tool, we've also learned that QE can be extremely valuable. There are a series of market shocks having to do with liquidity, financial crisis, changes in the demand for money, as we saw during the pandemic, create a need for the central bank to elastically change its balance sheet, and QE is a way to do it. Now, we've also learned, though, that comes with the central bank absorbing a little bit of risk, that balance of risk, that losses that it came, and that requires, going back to Rosanna's intervention, a very strong, credible framework of how the fiscal interaction between treasuries and central banks happens, How exactly are the mechanisms through which these losses are passed between these two branches of government, how they are shared? That is the key for that financial stability role to be well placed and for the loss to be dealt with. Now, to retain this valuable tool, though, going forward, and I think it will be a valuable tool, even if perhaps a less used one insofar as we don't have the financial shocks or inflation is high, I think takes, let's say, I think I've said 3 twice already, but I'll say it again, 3 requisites. Let's go for 3 again.
Quickly.
First, that we need that the balance sheets are going to have to be higher than they were, say, 20 years ago. I think we have learned that the demand for liquidity is higher, satiating the market for reserves, as academics used to call it. The Federal Reserve rebaptized that as the ample of reserves, as opposed to the saturating of demand for reserves, is important. Second, that in buying government securities, insofar as you can limit the risk, for instance, by reducing the maturity of the holdings that you have, that is important. That risk management, often a boring department of the central bank, is an important department and one that takes a lot more attention and in the frameworks be taken more seriously. And third, that paying interest on the deposit the banks of the central bank is very important to keep QE as a separate tool to the interest rate rules. And I worry when I hear, in my view, fallacies being said that interest on reserves is some form of subsidy to the banks. It is not, and keeping it is crucial to keep this ability to use the balance sheet.
Yeah, but you can pick your level, I think is the point there, Geeta. What's your view on QE, how it should be used, how it could be better managed in the future, perhaps escape clauses? How do we get ourselves out of this?
Yeah, I fully agree with everything Ricardo said here, which is there are times when QE can be very helpful. And those are times when demand is so weak that output is so much below potential, and central banks have taken the interest rate all the way down to their effective lower bound. And they have to find other ways to stimulate the economy. At that point, QE plays a role. So in this building, we refer to that as being in a deep liquidity trap. Right? That's what happened right after the GFC. For several years, that was the case. The countries were in that situation. And then you had the period right before the pandemic when output started pretty close to at full employment. If anything, actually, unemployment rates are going down. This was the case of the US. Unemployment rates are going down. And the reason the central bank is using QE is mainly to bring inflation fully back up to 1.8 to 2%, right? It's that gap. That's a shallow liquidity trap, right? You could call it that. That's a shallow, very shallow trap to be in. And in that situation, I think what we've learned from the last few years is in those circumstances, it's probably less useful to use QE.
Yeah.
For 2 reasons. One, it's just less effective. If you look at what the impact of that QE in that environment is, it's not very effective in stimulating the economy. And secondly, you're putting yourself in a much more riskier situation because if you recall, and this is to your point of escape clauses, was that central banks had these 2 instruments. There was the quantitative easing or buying bonds, asset purchases, and at the same time of cutting rates. And there was a communication which was, we will first stop QE before we start cutting rates, right? So there was they were in a bit of a straitjacket in terms of how to move. And I think the next, again, reform of the monetary policy framework should probably take that straitjacket off and make sure that there's less of the very precise articulation of the sequencing, and use QE in these extreme scenarios, but not in scenarios where you're pretty close to your inflation target, maybe not use it then. And I think that's the lesson that we've learned from the last few years.
Straight jacket off and perhaps bar higher. Rosanna, your view on this? Because I think I would like to get your wisdom on FX intervention, because I think this is something that cuts to the core of what emerging markets, but certainly your experience in Chile is, and what you've learned from that in the last 3 years.
Yeah, we have 2 experiences of in which we have to intervene the market.
Yeah.
But we are firm believers that our framework is very useful, yes? And our framework, as I have said, is a framework of inflation forecast targeting, but with flexible exchange rate. What does it mean? It means that we intervene in the markets, but only in extraordinary conditions. And what that extraordinary condition is, that is moment in which we can perceive that the markets are not functioning adequately. Malfunctioning is the reason to intervene markets. In both opportunities, in 2019 and in 2022, what we can perceive was an ample evidence that the price formation has a very clear disorder. Markets are not being able to form adequately prices in the FX market. Also, we perceive very clear that there is a very important risk that this effect could produce spillovers or over other segments of the financial market. In our case, in specific, the fixed income market. So when this is occurring in the market, we intervene. It's not a problem of the level of the exchange rate. It's not a problem of one volatility or another. It is if the effect of what is happening is that we can perceive clearly a malfunctioning of the market, we can intervene. It is very important, but prior than the intervention, you need a market that has the resilience enough to solve the situation alone. To do that, it's very important to work in the resilience of the market. During this year, during the past years, we suffer in the Chilean market a loss in liquidity and depth of the market. So it is very important for us to build resilience. When you have withdrawal of a quantity, 20% of the GDP, you have lost a lot of long saving in your market. And this produces a very different way of functioning of the market. So we need to increase saving. We need to build new instruments to reinforce liquidity between the private sector. For example, we were working in the development of a repo market. We were working in many norms to increase internationalization of the peso, at all building resilience in the market, because this is the first step. We act only when this resilience is not enough and the market began or stopped working adequately.
I think the message on liquidity is important for emerging and developing markets as much as it is for advanced and developed markets. What about in crisis, in moments of challenge, liquidity support to the non-bank sector? How do you feel about that? What do corporations do? What do businesses, households, or do you leave that to the government? And
if I may, Julia, before saying a word on liquidity, one word on QE. I'm also a QE supporter, but we should be clear. I will state the obvious. We are all aware in this audience that the purpose of QE is not to help governments, nor is the purpose of QT to penalize governments. I stress it because there is a huge ambiguity probably in Main Street, outside of this room, in all our countries. The purpose of QE in specific cases is to ease the monetary stance, and so to diminish the term premium and the long-term yields. And there should be limitations in use. I agree with most of what Ricardo and Gita said. I liked very much, Gita, by the way, the image of the straitjacket. It was in the past sometimes self-imposed, so let us free ourselves of the straitjacket in the future. And
can I change my question? Or you can answer it anyway, but the interaction between other tools, QE, without the straitjacket.
No, this was my point about liquidity, if I may. And
following
what Rosanna said, probably part of the job which was done in the recent episode by QE can be done in the future by other liquidity tools.
Okay.
If your aim, a central bank, is to provide liquidity without changing the interest rates, then we have other tools. And by the way, let me stress that the ECB was very innovative in this field. We were the first central bank to introduce what we call LTRO, long-term refinancing operations, 3 years. And then we even invented TLTRO, targeted LTRO, associated with credit incentives. And it worked very well. And it doesn't bear interest risk, contrary to QE. We made some mistakes in the past in the calibration of the pricing of TLTRO in 2020, but we corrected it, so we learned. I strongly believe these instruments could be more useful. By the way, the challenge we have in advanced economy is that we still have excessive liquidity following the years of QE, and now we should aim to come not to scarce liquidity, it would be a mistake, but to ample or adequate liquidity. And this transition, we are just succeeding in it with the operational framework. About non-banks, it's an open question. Most of us are cautious on this issue for a very simple reason. When you provide liquidity, you must supervise and regulate. And if you provide liquidity as a lender of last resort, but you have no precise views of the risk of your counterpart, then it could be a difficult situation. So at present, at least for the ECB, we channel liquidity to the economy through banks, which we regulate and supervise.
Yeah, but you answered my question, which is I think there are liquidity tools that perhaps are superior to bond buying, which is another lesson we've learned.
But this is for different situation. Again, if you have a purpose of monetary stance and lowering long-term yields, QE cannot be replaced. So we still need QE.
Okay, I'm very conscious that we don't have much time left, and there are a lot of people in the world that have faced rising prices and are struggling. And we're saying it's been a success to get inflation, for the most part, under control, but prices are still significantly higher. The IMF managing director said to me yesterday, we're not popping any champagne corks. But for those that are listening to this message, as a result of what we've been through, this kind of discussion, the lessons that we've learned, are we in a stronger position today, and as a result of the policy framework reviews that we'll now go through, to help support, to help control shocks, deal with shocks better than we were even 2, 3, 4 years ago? And you each have 30 seconds to answer. First of all, your 30 seconds. Are we in a better place today?
No, we should never be complacent or lazy. But I think we are in a better position. But we live in a more volatile and dangerous world. Yeah. So there is a balance between the two parts of my sentence. Time will tell.
Rosanna.
So we need to be prepared for volatility. We are in a world more volatile. We need to build resilience. We need to rebuild buffers in our economy. We need to face the future with this very firm structure.
Yeah. Ricardo?
Yes. To the people who are still suffering with the high prices, I would say that by controlling inflation, we can now enter the stage where their wages and their incomes catch up to the loss in purchasing power they had in the last 2 years. By keeping this episode, even if sharp and then avoidable given the shocks, but short, we can make sure that they'll be back on track very, very soon. And that is the important thing. And moving ahead, again, that shocks will come, two-sided, one side or the other, but with a determined policy framework, made sure that this was a short-lived episode. And that, I think, with the right humility, is the best that policymakers can do.
Yeah. Peter, final word.
Yes, we are in a better place. We have better frameworks than we've had in the past, including in Chile in terms of fighting inflation and fighting many other sources of spillovers that come from the rest of the world to small open economies. Yeah. We are in a better place, but going forward, we have to continue to learn, observe, adapt. This job is not done, but I have confidence that we're in the process of doing the best job possible. That does not mean that there will not be another period when inflation goes up and price levels rise again. I don't think that can be ruled out, but it will beat the alternatives.
Confidence, humility, and time will tell. Thank you, ladies and gentlemen, your panel. Thank you. Nicely done.